What's going on, guys? This is Vlad, and today we're going to talk about how to trade inefficiencies using algorithmic price and, yes, you guessed it, time. Inefficiencies are one of the most important concepts when it comes to price delivery. Um, these are levels where price was not efficiently delivered, meaning these levels, they lack either buy side or sell side delivery. So naturally, the market will want, um, naturally, the market will draw towards them in order to um, utilize that liquidity that's built there. It's a level of liquidity like there are orders that were not efficiently filled, and that's what makes inefficiencies um, act like a magnet, or like ICT says, like black holes for price. Okay, and it's important to know how to trade them, or especially when we are talking about big inefficiencies. Okay, small ones, they are a different story, but I'm showing you here particularly how to trade these ranges when they are relatively big and they allow for you to capitalize on some very, very good larger moves. Okay. So in this particular example, today we are going to explore opening range gaps. So that's the form of inefficiency we are going to look at it today. Other types of inefficiencies I will also show, but the logic will be very, very similar to this one. Okay. So let's try to understand how the market is feeling these inefficiencies. And here I'm looking at the price action of this Tuesday, April 8th, 2025. And we had a very large opening range gap. It was around 460 points, okay? 460 points opening range gap that we filled entirely throughout the first half of the day before ultimately going lower. Okay, so as you well know from ICT, and I taught that in one of my previous videos as well, right at the opening price, we want to look at two key liquidity levels, and these are the high and the low that formed before 9:30, and particularly I'm talking about the range from 8 o'clock until 9. Okay, so 8 o'clock is here, and the lowest low is this one, and the highest high is this one. Okay, so these are two key liquidity levels where we have sell stops and buy stops, and the algo will usually try to unsettle both sides of the market around these levels. Okay, it will use these levels in order to deliver the daily objectives. So initially we go up, we take that high here at 925, then we trade back into the opening range gap and ultimately away from it. We have a little bit of consolidation here until 10:30, and then the market starts dropping and starts delivering within the opening range gap. Okay, you know from ICT that there is a 70% chance that the opening range gap consequent encouragement will be traded to within the first half hour of the morning session. Well, in that particular case, because we have 460 points opening range gap, which is a massive, huge gap, these probabilities are not in our favor. So it will take a while before the algo gets there and ultimately to the bottom of this opening range gap. So you see exactly that here. After we start trading down to the gap, there are several things that you should know if you want to capitalize on all these price moves that you see happening within the opening range gap. Um, if you studied the 2024 mentorship from ICT, I highly, highly recommend this because all these things that I'm sharing with you, ICT spoke about them in the mentorship. Some of them he just hinted at, and you have to study a little bit more in order to make your own findings and conclusions. Some of them he shared directly with us, with the community. Um, so I hope you picked up at least on those. But anyway, I'll try to make it as clear as possible. So whenever you have an inefficient range like this, you want to have, of course, that range graded. Graded means whenever you're grading the range, it means you want to include the quadrant levels, not only the consequent encroachment, so the midpoint, but you also want to have each quadrant level on your chart. Why? Why do we want that? Because the quadrants are also algorithmic levels that um, serve a purpose there. The algorithm is using them to drop inefficiencies in and around them. It's using them as a reference point for price for future price delivery. Okay, if you're bearish, and on that day we were bearish, after we took the buy side, we had this 850, 849 low. That was the next objective on the way down. You see that this level coincides almost perfectly with the consequent encroachment of the opening range gap. So that's a double confluence there. We have relative equal lows with this 740 lows. But ultimately, we also had right at the bottom of the gap, right below it, we had Asia low, which created relative equal lows with London here. So these are candidates for um, these are candidates to be rated by the market after 9:30. Okay, so overall we had a bearish bias. So how do we trade within that opening range gap? Where do we find our setups? So after you graded the range, you want to see these quadrants being traded to in a specific way, okay, which supports your bearish bias. Like, imagine that each of these quadrants is a range within itself. So, what do I mean here? After we take the first quadrant here, you expect you can expect a retracement up before going down to the next quadrant, which will be here at equilibrium. Each next quadrant that we take, you can expect price to retrace back to the previous quadrant before extending further down. Okay, so this is for your notes, and this is something for you to study around inefficiencies because this is a repeating phenomenon. And if you recognize these things, you'll be able to catch really, really good moves, like this one that I'm going to show you here. So you see price going down to the second quadrant, then it's retracing back to the first, goes back down to the second, retraces back to the first quadrant. Okay. Then we start going down. Here we take equilibrium, trade into the third quadrant. So second quadrant is now delivered. Trading into the third quadrant, retracing back up above equilibrium, back into the second quadrant before going down to the fourth and last quadrant. At the fourth quadrant, price is likely to not go back to the third, but rather deliver the full range of the inefficiency before it retraces back up. Okay, around the last quadrant, one more time, the price is likely to speed up, or in this case, is going to speed down to take the entire inefficiency before it retraces up. So what do you see here? What you see here above, from first quadrant to second, then back to first, then going to third, back to second. Once we go to the fourth and last quadrant, you will see speed. Okay, this retracement, it happens after we close the inefficiency completely. You see that? And then ultimately we trade out of the opening range gap, back to it, inefficiency. This should ring a bell for you. I taught that already in previous lectures. This return to the opening range gap and then leaving an inefficiency, rejecting it, leaving an inefficiency on the way down. This is your high probability short, okay, to continue further down. Okay, but that's a subject for another lecture. So how is price when it's retracing back to the previous quarter? Where is it retracing to? It's retracing to levels of inefficiency. Okay. You can see here that in each quadrant above there is an inefficiency that formed before we retraced back to it. Okay. See how here we are trading down to the second quadrant and then back up to what? These fair value gaps, these inefficiencies, they formed in the first quadrant. Do you see that? Do you see this wick? Where this fair value gap formed? In the first quadrant. So back to it, then delivering down. We form another inefficiency here above equilibrium. So we're going back to it, and then we go down. You see the logic? Your inefficiencies will form in the previous quadrant. Price will retrace to it and then continue on its way down. And I know many of you already probably wondering because it's hindsight, and you're wondering, yeah, but I would have been stopped here. Look at this one; it didn't retrace to any inefficiency. It took this high. There is no inefficiency here. Like, what are we looking at here? Well, that's for the untrained eye. That might be true, but let me give you a perspective here. Let me put some lipstick on the chart and make these light bulbs in your head turn on. Ready? Look at the magic of the algorithm. This retracement here is back to the first presented fair value gap after 9:30. It's this one. And if you don't have a moment of enlightenment here, I don't know what will give it to you. I mean, that shit is scripted, guys. I'm telling you, it absolutely is. So, anyway, we're trading back to it right at, what is it, 11:40, 11:41. So we're at the beginning of the launch macro now. Then we displace away from the first presented fair value gap. We displace away from the upper quadrant of the opening range gap. You see that? What is this here that's happening? Displacing away once, trading back to the first presented fair value gap, then displacing again second time. Yes, that's your high probability short, trading the first presented fair value gaps right there for you. The model that I'm teaching you in my last videos, this time blended with the opening range gap to deliver to you the like deliver this highly accurate algorithmic price logic that if you cannot see it, I don't know how else I can prove to you that the algo is real. Like if you pay attention to these things, you'll see it. I'm pretty sure. So that's the same exact model. You have further confluence here that the gap formed in the upper quadrant. We're trading back to the lower quadrant. This gap here is the first presented fair value gap after 11:30. So that's the launch first presented fair value gap. Okay, this is the gap that we will use during launch for our launch objectives. Okay, so after we trade to the second quadrant, price retraces back to this inefficiency. And now pay attention, because we confirm that the first presented fair value gap of the morning session is giving a short signal. Once we are in the second quadrant, when we go back to the first quadrant, you can expect that we'll touch the launch gap. So this gap here, even though it's in discount, it's a good opportunity to short. And I don't deny that. It is a good opportunity to short, but because you have the launch gap formed right above it, you know that the rules say that whenever you have two gaps, you have to, ICT is advising you enter on the first, but you have to consider price wicking to the second. So your stop loss has to be above this candle's wick. Yeah, but if you know that the launch gap form here and the AM session gap already gave the short setup, is it reasonable to expect that we'll trade back to the launch gap before continue down? Yes, it is reasonable to expect that. Okay, it's absolutely reasonable to expect that. These gaps also, guys, if you draw your range and equilibrium here, you'll see that this inefficiency here, the larger portion of it is in discount. So it's reasonable to expect that we'll trade to the upper half of this CB before going down. But as I said, you already have the first gap for launch right up there. So you can expect that price will trade there. It will trade there, and it does. And it stops dead on its track, hitting this gap 3 times before it starts going down. Okay. Goes down, as I said, to the next quadrant. Then we have a retracement to the previous quadrant. Okay. Here, 12:30 is usually when the second delivery for the launch session starts. Sometimes it's a continuation. Sometimes 12:30 might be a reversal. Okay, it depends on the daily profile. In this case, it's a continuation. So it retraces back to the previous quadrant and to this gap. Now, the launch gap here, it did the exact same thing the AM session gap did. it provided a short setup. So here though you have one, you can count this one also, 2, 3, 4 inefficiencies consecutive. Okay, 4 consecutive inefficiencies. So how do you know how deep it will retrace? Well, this first gap is a breakaway gap. First of all, because you have this consolidation. So this gap breaks away from the consolidation. Also because of these green candles, and of course the consolidation before that, this range is very much balanced. So you can expect that this gap should stay open. Okay, it's better if it stays open. This is your breakaway gap. So your stop loss can be above this candle. Okay, if you're a little bit more conservative, as you don't want to see price reach here. We already in the lower quadrant, third quadrant. We traded deep into the third quadrant. So you can expect the price will continue down. Now, whenever you have three gaps, I'm saying three because we already agreed that the breakaway gap should not be touched. You can enter on the first one, but your stop loss should consider that the price might wick to the second one, or at least to the consequent encroachment of the second one. So if you're a little bit more aggressive, you can put your stop above this candle high. Okay. It's going to be something like this. You enter on the first, like here, and stop loss would be like this. Okay, and then you can target the next quadrant for 2R. You can target the low of the opening range gap for 4R, or ultimately there was a new day opening gap below, where is the Asia lows as well for 5R. So wonderful setup right there. Very little drawdown, almost nothing, no drawdown. Okay. Uh, anyway, once again, you see the magic, guys. This is the logic how you trade inefficiencies. It's something to keep in mind, especially when the inefficiency is large and you're not gonna have like a you're not gonna close the inefficiency with 2 3 candles. If it's like 50 points, you might actually see that closed in a single pass, or in 2 3 candles. But whenever you have a significant range like this one, this is how price will usually trade within that range. So your job is to identify where are the inefficiencies in the upper quadrants, which we will trade to before um, continuing down. If we're trading up, the logic is the same. Your discount levels, your discount BCs will form in the previous quadrant. So if you're trading from the first to the second, then the first quadrant, you should have a BC. We're going to retrace to it, then go up to, let me grab this. So you're in the first quadrant trading to the second. You're going to go down to the first. There should be a BC here, then up above equilibrium, then down. There should be a BC here below equilibrium, then up. And usually in the last quadrant, sometimes it will retrace back into a BC, but many times it won't. It will just speed up and ultimately deliver the entire inefficiency. Once it's here, you can expect speed. If there is no speed, it is very likely. I mean, you should look what's happening on the left. It's very likely that you might see a reversal or a deep retracement. Many times, if you don't see speed, but we are supposed to close the gap that day, you might see a retracement back to the first quadrant. Okay, that's something that I discovered many times. It happens like there is this it's like a turtle soup, or like just to take out uh, anyone who was winning. here on these longs, take them out, and then from here, from the first quadrant, it will aggressively start delivering back up and close the entire inefficiency. That happens many times. Okay, so you should be aware of it as well. Anyway, guys, do you see also here that these things, for example, this one, the setup formed at a macro. Uh, I don't even have to say that anymore. It just happening all the time. I, I just leave it to you to figure that out. But also, I wanted to show you something else here. Why? Um, See, when we trade down to the last quadrant, is there an inefficiency here that formed in the lower half of this quadrant? No, here in that range. There's no inefficiency here. But what else do we have here? We don't have an inefficiency like when price is retracing back to it. We don't have an inefficiency, but we do have what? What is this? These two up close candles. I also taught that in a video recently. That's a high probability order block. Why is a high probability order block? First of all, because you have this CB where price fails let me put the midline and put it to the back. So when a price fails, since it's a CB, I like to have it in red. Price fails to trade to the consequent encroachment of this CB on these green candles. They should be up close candles, okay? And then one single pass through the opening price of this of the lower bullish candle. That's your high probability bearish order block, okay? These two green candles. The entire range of these two green candles is a high probability order block, okay? I'm just marking the body because that's your change in the state of delivery. But when you have the order block, you can consider the entire range of these two candles. So if we, let me use that as the order block, like this entire range is your order block. See this? Back to the order block. We don't need to trade here. Why? Because this also is a balanced price range. That's an inversion fair value gap, this green one. But this whole range, you see that? Single pass down. All these green candles are completely balanced by one down close candle. Balanced price range, high probability order block. Boom. Hit it, consolidate, and then continue down. And here was your setup for the PM session using the same logic, um, I outlined. How you trade first presented fair value gaps, you can trade the same way opening range gaps. Once we leave the opening range gap with a displacement here, see, back to it, then another displacement. That's your high probability short. And ultimately, from this level down, so it's, let's say it's the low of the end dog, down we deliver another 660 points, which is absolutely wild. It's absolutely wild. Crazy times to be in the market right now. Um, okay, and just for the sake of it, I wanted to show you also. This is here the first presented fair value gap of the PM session. I like to have that purple. No, okay, extend to the right. All right. Just for the sake of it, I wanted to show you how, once again, we worked that gap several times here. This big up close candle, which by the way is a 1 minute candle with a 200 points range. So you understand why the markets are dangerous right now. But it's still algorithmic. Still fails to close above. After we displace here, see that CB? We're displacing away from the first presented fair value gap of PM. Failure to close above it. Then what do we do here? We displace again here. Oh my God, guys, if you can't see that, I don't know how to help you, honestly. I'm literally doing the 2024 mentorship for you here. Shortcut it big time for you here. Um, See, that's your CB. Actually, let's make it red. It's a bearish setup. That's your CB consolidation. What time is it? 12:53 when we start moving down. So it's a macro. Yeah, it's a macro. Surprise, surprise. This here, balance price range. This BC, inversion fair value gap. If you can see it, guys, I don't know how to help you, honestly. Honestly. But anyway, let's not sidetrack too much from the main topic on how to trade inefficiencies. If you like this video, hit the subscribe button. Please leave a like and comment. Do you guys like this kind of videos? Do you want more of it? Is it easy to understand what I'm trying to explain here? Let me know, and I'll consider your feedback. Uh, did you do you have some other way to share with us on how you trade inefficiencies, how you like to look at the market through these similar uh, PDA racing concepts? Let me know in the comments, guys, and stay tuned for um, other videos on how to trade inefficiencies, different types of inefficiencies. Okay. Until I speak to you next time, uh, love for every one of you. Stay safe, and I'm out of here.